Most people think credit cards are dangerous. The moment someone hears the words credit card, they imagine debt, high interest, and people struggling to pay off balances for years. And to be fair, that fear isn't completely wrong. Millions of people are stuck in credit card debt right now, paying enormous interest rates every month. But here's the interesting part. The credit card itself isn't the real problem. The real problem is that most people never learn how the system actually works. Because once you understand it, something surprising happens. Credit cards stop being a financial trap and start becoming a powerful financial tool. And there's one simple trick that banks quietly hope most people never figure out. Before we talk about that trick, we need to understand how credit cards make money in the first place. Every time you swipe a credit card, a small financial transaction happens behind the scenes. You buy something at a store, restaurant, or online shop. The bank that issued your credit card immediately pays the merchant for that purchase. In simple terms, the bank temporarily covers the cost for you. Later, at the end of your billing cycle, the bank sends you a statement listing everything you bought during that month. At that moment, you have a choice. You can pay the entire balance, or you can pay only part of it. This decision is where everything changes. Most credit cards display something called a minimum payment. This amount is usually very small compared to the total balance. For example, if someone owes $3,000, the minimum payment might be only $60 or $80. It looks manageable, it feels safe, but here's the truth most people don't realize. Minimum payments are designed to keep people in debt for as long as possible. When you only pay the minimum, most of your payment goes toward interest instead of the actual balance. That means the total amount you owe barely goes down, and the bank keeps charging interest month after month. And credit card interest rates are extremely high. In many countries, including the United States, average credit card interest rates are now around 20 to 25%. To understand how powerful that interest is, imagine someone has a $5,000 credit card balance with a 22% interest rate. If they only make minimum payments, it could take years to fully pay off that balance. During that time, they might pay thousands of dollars in interest alone. That's where banks make most of their money, not from the card itself, not from annual fees, but from interest paid by people who carry balances. This is why banks spend so much money encouraging people to use credit cards more often. They offer cashback rewards, travel points, airline miles, and huge sign-up bonuses. At first glance, these rewards seem incredibly generous. You might see a credit card that offers 2% cash back on purchases, or a travel card that promises a free flight after spending a certain amount. But banks aren't giving away free money out of kindness. They do it because they know something about human behavior. When people use credit cards, they tend to spend more. Studies have shown that consumers spend roughly 12 to 18% more when using credit cards compared to cash. Psychologically, swiping a card doesn't feel the same as handing over physical money. The pain of spending feels smaller. And when people spend more, they are more likely to carry balances. That's when the interest begins. This entire system is built around the simple idea: encourage spending, then profit from interest. But now we arrive at the trick that banks rarely explain clearly. Most credit cards include something called a grace period. A grace period is the amount of time between when you make a purchase and when interest begins to apply. For most credit cards, this period lasts between 21 and 25 days after the billing cycle ends. During this time, if you pay your entire balance in full, you are not charged any interest at all. Not a reduced amount, not a small percentage, zero. That means if someone uses their credit card regularly but pays the full statement balance every month, the bank doesn't earn interest from them. Instead, the cardholder receives all the benefits. They get cashback rewards, they get travel points, they build a positive payment history, and they pay no interest. In other words, they use the credit card system without falling into the trap. This is exactly how financially disciplined people treat credit cards. They don't see the card as borrowed money. They treat it like a debit card with a short delay. Every purchase they make is something they could already afford with cash. The credit card simply acts as a middleman that records the transactions and provides rewards. Then, before the due date arrives, they pay the entire balance. No interest, no debt. just convenience and rewards. Over time, something else happens as well. Their credit score improves. A credit score is a number that represents how reliable someone is when borrowing money. Lenders, banks, landlords, and sometimes even employers look at this number when evaluating financial responsibility. Credit scores are calculated based on several factors. One of the most important is payment history. Consistently paying bills on time shows lenders that someone is dependable. Another factor is credit utilization. Credit utilization measures how much of your available credit you are using. For example, imagine someone has a credit card with a $10,000 limit. If they carry a $5,000 balance, they are using 50% of their available credit. This is considered high and may lower their credit score. Experts generally recommend keeping credit utilization below 30% and ideally below 10%. People who understand this strategy often take it one step further. Instead of making only one payment per month, they make two. One payment before the statement closes, which reduces the balance that gets reported to credit bureaus, and another payment before the due date, which clears the remaining balance. This keeps utilization low and can help credit scores improve faster. Again, this isn't something banks advertise heavily. Customers who carry large balances are far more profitable, but those who manage credit carefully gain significant advantages. A strong credit score can reduce the interest rates you pay on loans. For example, someone with excellent credit might receive a much lower mortgage rate compared to someone with poor credit. Over the lifetime of a home loan, that difference can save tens of thousands of dollars. Car loans, personal loans, and even insurance rates can also be affected by credit scores. In other words, responsible credit card use can quietly open many financial doors. However, it's important to understand that credit cards are still powerful tools, and like any tool, they can cause damage when used incorrectly. There are a few simple rules that people who succeed with credit cards almost always follow. The first rule is never spend money you don't already have. If someone treats their credit card like free money, the balance can grow quickly. Interest charges begin stacking up and the situation becomes harder to control. The second rule is always pay the full statement balance. Paying the minimum payment may keep the account in good standing, but it allows interest to accumulate. Paying the full balance prevents interest entirely. The third rule is to avoid impulse spending. Because credit cards make purchases feel effortless, it's easy to buy things without thinking carefully. Creating a habit of reviewing purchases and sticking to a budget can prevent this problem. The fourth rule is to understand the reward system without letting it control your behavior. Cashback and travel points can be valuable, but they should never justify unnecessary spending. Buying something you didn't need just to earn rewards defeats the purpose. Interestingly, when you follow these rules, something ironic happens. You become one of the least profitable customers for the bank. Think about it. You pay no interest, you collect rewards, you build your credit score, and the bank earns very little from you compared to someone carrying a balance. But banks still allow this system to exist because the majority of people never follow these rules consistently. Many people start with good intentions. They plan to pay the balance in full. But then an unexpected expense appears. A medical bill, a car repair, a temporary loss of income. Suddenly, the balance carries over to the next month. Interest begins accumulating and escaping the cycle becomes difficult. This is why financial discipline matters far more than the card itself. The credit card isn't the trap. The behavior surrounding it is. When used responsibly, credit cards offer several benefits beyond rewards and credit building. They provide purchase protection, which can help in cases of fraud or defective products. They often include travel protections, extended warranties, and fraud monitoring systems. If a debit card is compromised, money can disappear directly from a bank account. With a credit card, fraudulent charges can often be disputed before any payment is required. These protections add another layer of convenience and security. But again, these advantages only matter if the user avoids carrying debt. Because once interest begins accumulating, the benefits disappear quickly. Paying 20% interest on a balance will erase almost any reward benefit. So, what's the real lesson in all of this? It's surprisingly simple. Credit cards are not inherently good or bad. They are tools, and like any tool, their impact depends on how they are used. Used carelessly, they can trap people in long-term debt. Used wisely, they can build credit, provide rewards, and offer financial flexibility. The trick banks rarely emphasize is that the system can work in your favor if you follow one simple habit. Use the card, but never carry a balance. Pay the full statement amount every month. When you do this consistently, the credit card stops being a source of stress. Instead, it becomes a quiet financial ally, a small everyday tool that improves your credit history, protects your purchases, and even gives you rewards along the way. And sometimes, the biggest financial advantages don't come from complicated investment strategies or secret insider knowledge. They come from understanding simple systems that most people overlook. Once you see how the credit card system truly works, you realize something important. The real trick banks don't want you to know isn't complicated at all. It's simply that the smartest way to use a credit card is to never pay interest on it.